price is moving. It's climbing fast, a powerful bar pushing higher and higher, and you are paralyzed. Your mind screams, "It's too high, it's going to fall back down." But it doesn't. It keeps going relentlessly. The opportunity is slipping through your fingers, and the fear of missing out is now wrestling with the fear of buying the absolute top. You feel trapped between two bad choices: chase the price and risk an immediate reversal, or stand aside and watch profits accumulate for everyone else. This paralysis, this conflict between greed and fear, is one of the most common and costly experiences in the market. It stems from not understanding the difference between simple upward movement and a true, undeniable sign of strength. What you are witnessing is not just random price fluctuation. It is a deliberate and powerful statement by the market. A true sign of strength is a clear signal that the balance of power has shifted decisively from sellers to buyers. It is the moment when demand overwhelms supply with such force that the price is propelled upward with significant momentum. This is not a gentle drift. It is an explosion of buying interest. Imagine a massive logjam in a river. For weeks, the logs, representing shares for sale, have been piling up, preventing the water from flowing freely. The price moves sideways, trapped. Then suddenly, a surge of water, immense new demand, hits the logjam. It doesn't just nudge it, it shatters it. The logs are thrown aside, and the river rushes forward with incredible force. That rush, that release of pent-up energy, is the sign of strength. This is not an accident. It is the culmination of a careful process executed by large, informed operators. During the preceding sideways period, which we call a trading range or consolidation, these large interests were patiently absorbing shares from the public. They were buying quietly, trying not to alert the crowd, absorbing all the shares that weaker hands were willing to sell at those low prices. The sideways movement is the evidence of this absorption. When they have acquired the amount of stock they desire, they have one final task: to ensure that the majority of sellers are exhausted. Once they are confident that there is little overhanging supply left to impede an advance, they allow the stock to move. Sometimes they even initiate the move themselves with large buy orders. The resulting price action is what we see as a sign of strength. It's the market announcing that the path of least resistance is now unequivocally upward. The two key ingredients you must observe are price spread and volume. The price spread refers to the range of the price bar for a given period, from its lowest point to its highest point. During a sign of strength, you will see unusually wide price spreads. The bars on the chart become elongated, stretching upward. This shows that buyers were willing to pay higher and higher prices within a very short period. They were not timid, they were aggressive. This aggression demonstrates conviction, but price alone is only half the story. The other, and arguably more important component, is volume. Volume is the fuel for the market's engine. A price move without volume is like a car rolling downhill without its engine on. It's not a sign of power, but of temporary momentum that will soon fade. A genuine sign of strength is always accompanied by a significant increase in volume. Think of it as the number of shares changing hands. High volume during a strong upward move confirms that there is broad participation and powerful commitment behind the move. It tells you that the large operators are involved, and they are not just testing the waters, they are making a decisive move. The combination of wide price spreads and high expanding volume is the fingerprint of institutional buying. It's the market speaking its language, telling you that demand is now in firm control and supply has been removed from the immediate picture. Ignoring this combination is like ignoring a thunderclap that follows a flash of lightning. They are part of the same powerful event. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original, timeless wisdom, presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding these foundational texts is not optional for those who wish to move beyond guessing and into the realm of professional analysis. The market leaves clues, and these works teach you the language in which those clues are written. Now, let's visualize this process so you can recognize it without needing to see a chart in front of you. Picture a group of people trying to push a very heavy boulder up a hill. For a long time they push, but the boulder only moves a few inches back and forth. It's a stalemate. This is the trading range, the consolidation. There are as many people trying to stop it from rolling up, sellers, as there are people pushing it, buyers. The volume of shouting and effort is moderate but constant. Then a new, much larger and stronger group arrives to help push. Suddenly, with a great collective heave, the boulder lurches forward and begins to roll up the hill with accelerating speed. The shouting and effort, the volume, reaches a crescendo. The distance the boulder travels in one big push, the price spread, is greater than any single move it made before. That powerful, committed, high-energy shove is the sign of strength. It changes the entire dynamic of the situation. The previous resistance has been overcome. The psychological mistake that uninformed participants make is to see this initial powerful move and be consumed by fear. They think, "I've missed it, it's run up too much." Or, they are overcome by greed and jump in right at the peak of that first explosive move, just as it takes a natural pause. The professional operator thinks differently. They see the sign of strength not as an end, but as a beginning. It is a confirmation of their analysis. It is the signal that the period of quiet accumulation is over, and the next phase, the upward trend, is likely beginning. They do not chase the initial surge. Chasing is an emotional act, and the market punishes emotional acts. Instead, they wait with the patience of a hunter. They know that after a sprint, even the strongest athlete needs to take a breath. This brings us to the practical algorithm, the action plan. How does one act on a sign of strength without getting caught in the emotional traps? The first step is to identify the proper context. A sign of strength is most meaningful when it emerges from a well-defined period of consolidation. The longer and more orderly the sideways base, the more significant the eventual breakout. You must first see the cause, the quiet absorption of shares, before you can have confidence in the effect, the sustained upward trend. A sudden price spike out of nowhere without a preparatory base is often untrustworthy and can be a trap. So rule number 1, look for a sign of strength that breaks out of a prior trading range. This is the jumping the creek, as Wyckoff would call it, a decisive leap over a previous area of resistance. Once you have identified a valid sign of strength emerging from a base, characterized by a wide spread bar and a dramatic increase in volume, the second step is to wait. This is the hardest part for the impatient mind, but it is the most crucial for professional execution. You must wait for a pullback or a secondary consolidation. After the initial explosive move, it is very common for the price to dip back down slightly. This is called a backup action or a test of the breakout area. This happens for several reasons. Early buyers who got in at the bottom of the range may take some profits. Short-term traders might sell, expecting a reversal. This temporary increase in supply causes the price to retrace a portion of its big move. This pullback is not a reason to panic. On the contrary, it is the opportunity the professional was waiting for. It allows you to enter the market at a more favorable price, and it provides a crucial piece of information. The character of this pullback tells you everything you need to know about the authenticity of the initial sign of strength. What you want to see is a pullback that occurs on significantly lower volume. Picture our boulder again. After the big shove uphill, it might roll back a tiny bit before settling on a new, higher ledge. If it rolls back slowly and quietly with little force, it confirms that the upward momentum is real and the boulder is now stable at its new level. If the price pulls back on low volume, it tells you that there is very little selling pressure. The sellers are exhausted. The large operators who initiated the move are not selling. They are holding their positions, absorbing the small amount of profit-taking. The trigger for action comes when this low-volume pullback stops. You might see the price form a small shelf or a single bar that shows buyers stepping back in to support the price. For example, a bar that dips down but then closes near its high shows that an attempt to push the price lower was rejected. This is your entry point. You are entering not on the initial excitement, but on the confirmation of strength. You are buying when the market has proven that the new higher ground is solid and defended by buyers. Your entry is logical, not emotional. It is based on the evidence of supply drying up after a clear demonstration of demand. Now we must address capital protection. A plan without a defensive strategy is merely a hope. Your protective stop-loss order is your non-negotiable line in the sand. It is the point at which your analysis is proven incorrect. Where do you place it? Logically, it should be placed just below the low point of the low-volume pullback. If the price, after showing all this strength, were to fall back below that level, it would negate the entire premise. It would mean the sellers were not exhausted after all, and the initial sign of strength was a deceptive feint. By placing your stop there, you define your risk precisely. You know the exact amount of money you are willing to lose on this one trade if you are wrong. This mechanical, unemotional placement of a stop-loss is what separates professionals from gamblers. The professional knows they will be wrong many times, but they ensure their losses are small and manageable while their profitable trades, which ride the new trend, are allowed to run. Let's consider the variations and scenarios where things do not go as planned, because the market is a master of creating exceptions. What if you see what appears to be a sign of strength, a widespread bar on high volume, but the price immediately collapses and falls back into the previous trading range? This is a critical warning sign. It is not a sign of strength, but its evil twin, an upthrust after distribution. This often signifies that large operators were not accumulating shares in the range, but were distributing or selling them to the uninformed public. They create a breakout to induce excitement and panic buying from the crowd. As the public rushes in to buy, the large operators use this surge of demand to sell their remaining inventory at high prices. The volume is high, but it is the volume of distribution, not accumulation. The immediate failure of the price to hold its gains is the key giveaway. A true breakout holds. A false one fails quickly. Another scenario is a lack of follow-through. The stock produces a beautiful sign of strength breaking out of its base. But then, instead of a small, orderly pullback, the price just stagnates. It goes sideways on dwindling volume. It doesn't fall, but it doesn't rise either. It's like our boulder was pushed up the hill, but now nobody is pushing anymore. It's just sitting there, losing momentum. This is a sign of caution. It indicates that while the initial demand was strong, there is no urgency from buyers to push prices higher. The large operators may be waiting for more news, or perhaps the initial buying was not as committed as it appeared. In this situation, the professional trader remains on the sidelines. The evidence is not clear enough. The market is not confirming its intention to trend. Patience is paramount. Waiting for clarity is a strategic position in itself. You don't have to be in every move. You only have to be in the moves that are clear and well-defined. So, to summarize the mental model, a sign of strength is the market's declaration that a new uptrend is likely beginning. It is not just price going up. It is price moving up with character and force. This character is defined by wide price spreads and high supportive volume. It most often occurs as a breakout from a period of sideways consolidation, where large interests have been absorbing supply. The professional does not chase this initial burst of enthusiasm. They wait for the inevitable test, the pullback that follows the breakout. They analyze the character of that pullback, looking for a decrease in volume, which signals the exhaustion of sellers. Their entry is triggered when that pullback finds support and buying resumes, offering a logical entry point with a clearly defined level of risk. This approach transforms trading from a game of emotional reactions into a process of methodical execution. You are no longer reacting to fear or greed. You are reading the story that the market is telling through the interaction of price and volume. You are identifying the footprints of the large, informed operators and aligning your actions with their probable intentions. This does not guarantee that every trade will be a winner. There is no certainty in markets, but it provides a framework, a logical structure for engaging with an environment of uncertainty. It stacks the probabilities in your favor. By understanding the true meaning of a sign of strength, you move from being part of the crowd that provides liquidity to the smart money, to an operator who understands the mechanics of the game and can act in harmony with the market's primary forces. If you want to continue to understand these forces at a deeper level, to decipher the language of the market's behavior, then continue to follow this work. The journey to mastery is a marathon, built one sound principle at a time.